The UK has been described as a backwater and the Jurassic Park of markets. So what is the problem with the UK stock market and the economy? But also, what are the potential solutions and are they likely to work? This video is sponsored by NordVPN, which lets you securely connect to the internet across all of your devices. So let's look at, has the UK economy really become a backwater in a bit more detail. Let's begin with this characterization of the UK as a backwater or Jurassic Park. This is Nick Train, who's a very successful UK fund manager, and he knows pretty much all there is to know about UK stocks. And even he admits that the UK stock market has delivered grievously disappointing returns for longer than he cares to consider. Now, part of the reason behind that is that the UK has got very little tech as part of its stock market. Or as Nick puts it, the UK's unwelcome reputation as a backwater in the 21st century equity markets is symbolised by the absence in its upper echelons of globally significant technology champions. So our stock market is missing these huge unicorns like Apple, Microsoft and Amazon. Those have been behind the success of the US stock market over the last few decades. And writing in the FT, Paul Marshall, who's another very successful UK fund manager, said that the City of London is in danger of becoming a sort of Jurassic Park, where fund managers dedicate themselves to clipping coupons rather than encouraging growth and innovation. What he's talking about is a very large tilt in the UK towards stocks that pay high dividends. Remember, that's another version of value as a style of investing rather than growth, which has been just so spectacularly successful in the United States. And he puts it down to the composition of the investors into the UK market, which hugely favour stocks which pay a high dividend. So this is the income fund sector, and what Paul Marshall says is that it's time the income fund sector was phased out and replaced with funds that are more focused on growth than dividends. So a big jump from value to growth. And these funds are also focused on the future rather than the past. So pretty strong words. And it is truly remarkable if we compare global stock markets in 1900, you can see that in the top panel beside me, versus 2023. And what I've shown is the market capitalization, which is the size of each of the stock markets relative to the entire world stock market. Now notice that in 1900, the US and the UK were roughly the same size. The US was 15% of global markets, the UK was about a quarter of global markets. But if we fast forward to 2023, the situation couldn't be more different. The United States now makes up almost 2/3 of global markets, 58%, whereas the UK is essentially just a rounding error. It's 4.1% of global markets. People will know, if they're regular viewers, that I've got a FTSE Developed X UK fund as my core equity holding. And frankly, excluding the UK from that fund made almost no difference whatsoever. Excluding emerging markets will probably make a much bigger difference to the overall return, either positive or negative. So this is not a new phenomenon. This is something that's gradually been happening over many, many decades. Now, why has this happened? Well, in fact, it's not terribly surprising given the size of the UK. So, for example, if we look at the UK population, it makes up about 1% of the global population, in fact, a little bit less. So purely on that basis, we're punching well above our weight. And if we look at GDP, we make up about 2% of all the goods and services produced in the whole world. So the fact that we've got 4% of global equity markets means we're punching even further above our weight. And if we look at other countries, such as China, you can see that they make up 18% of global GDP, whereas they only make up also about 4 or 5% of global markets. So if anything, I'd expect to see China being a bigger proportion of global equity markets and the UK being a smaller proportion. At least that's what you'd expect over the long run. And one of the things that Nick Train mentioned was the very poor returns of the UK stock market versus, say, the United States. That's certainly been true over the last decade. So beside me here, you can see the total return for the US, but also just the capital gain. The total return's been 12.5%, the capital gain's been about 10.4%, and the difference between the two is about 2.1% from dividends. Whereas if we look at the UK, The overall returns are much lower. The total returns just under 7%, the capital gains 3.2%, but notice that dividends make up a much larger proportion of that UK return at 3.7%. Now, the problem is that if you're sucking that money out of the stock market and paying it to shareholders with dividends, then it's not being reinvested back into the company to grow its capital. So high dividend paying stocks, almost by definition, will not have a large market cap growth. But even taking those high dividends into account, it's still the case that the UK has performed very, very poorly, both in terms of total return, but also growth of market cap. And that's been going on for a very long period of time. Now, fund managers can't ignore that fact. And if we look at money that's managed within the UK, so these are UK managed equities, and we break down the asset allocation for those UK managed funds from 2011 all the way to 2021. What's very notable is that US equities doubled over that period of time, whereas the allocation to UK equity by UK fund managers has halved. It's also been the case that UK fund managers have de-risked over this period of time, moving money out of equities, but also whatever's in equity has been moved largely to the United States, where the returns are better. So there's a kind of downward spiral here. You get a period of underperformance. Even domestic fund managers refuse to put money into the UK market as a result, and it gets even smaller. Another problem is listings of new stocks. Remember, this is where the lifeblood of a stock exchange comes from. New stocks enter the market. They're kind of exciting and buzzy. They're usually high growth because that's what small companies do. So what's worrying is if we look at the UK market, the number of new listings is actually falling behind Europe. What you can see beside me here in red are the number of UK listings year by year versus those in Europe. And in 2021 in particular, notice that the value of new listings in Europe was much bigger than it was in the UK. And that's a trend that we've seen for some time. So not only has less capital flowed into UK markets from UK fund managers and elsewhere, but also new listings, which kind of create a buzz, have also been lacking for some time. I think this is also related to an economic problem in the UK, which is that we don't tend to invest a lot in our own businesses, particularly for research and development. New ideas don't come from nowhere. You've got to invest in that kind of research and development if you're going to grow new ideas, new lines of business, but also revenues. And if we compare the UK to other countries, we come out very low on a league table of research and development spend as a percentage of GDP. Another problem that the UK stock market faces is that it's usually valued less than the United States. So the orange line here is the price to earnings multiple for the United States, and the green line, which is at the bottom here at the moment, is for the UK. So simply by moving a listing from the UK to the US, you'd expect the stock to re-rate higher and to have a higher share price as a result. Or in other words, for exactly the same profits, an equivalent company in the US will have a higher stock price than that in the UK. So why wouldn't a company want to have a higher valuation? It would just be a natural inclination to move to another market where it gets paid more for its stock. Or another way of thinking of that is that the cost of capital is lower in the United States. Now, if I'm out and traveling and I want to connect to my brokerage account, I use NordVPN to ensure that all of my traffic is securely encrypted. And that's because there can be man-in-the-middle attacks, that's what you can see beside me here, where somebody can actually sniff out my passwords, but also see what I'm typing into my brokerage account, which I don't want to happen. NordVPN also filters out certain malware so that there's not going to be a virus placed on my computer as I'm browsing the web. But it's not just about work. Sometimes I catch up on movies, and if I'm abroad, I can log into the UK as if I was still back in the country, and that way see all the usual entertainment which I can get back home. Now, what's really key is that NordVPN is blindingly fast. It's never noticeably slowed down movie downloads while I've been out and about. This is what it looks like on an iPhone, and you can use it on your tablet as well as your phone and your laptop. So for example, here are a list of the countries where you could connect to a VPN, so it seems as if you're actually based in that country as you browse. In this case, you can see we've chosen a UK server. Connecting to NordVPN is really easy if you've got the extension built into your browser. Just click on Quick Connect, and that's it. Now all of your traffic will be securely encrypted. Viewers of PensionCraft get a special deal from NordVPN, where if you get the 2-year plan, you get an additional 4 months free. And to get access to that, just use the URL beneath me, nordvpn.com/pensioncraft, and don't forget that this comes with a 30-day money-back guarantee. You'll also find that link in the description beneath me. Now there are some oddities about the UK market. The first oddity is about concentration. So beside me here I've got 2 breakdowns of the largest 10 stocks in the UK and the US. The top panels for the US, the MSCI US index, and you can see that the top 10 stocks here make up about 15% of the total index. Contrast that with the UK, where the top 10 make up more than half of the index. So if you buy an entire UK tracker, then what you're going to end up with is something which is actually still quite concentrated in just a handful of stocks. And they're in these rather odd sectors, which is energy, healthcare, and consumer staples, but also some materials. And while we're talking about the sector composition, that's another oddity. So here beside me again, I'm contrasting 2 MSCI indices. The one on the left here is the All Country World Index. That's the entire global market. And you can see that information technology makes up about 1/5 of that index. Contrast that with the UK, where you'll see that information technology is right at the bottom of the list. It's almost invisible as a percentage of the total index. If we look at the differences in sector weights for those 2 indices, that's even more clear, where you can see that there's a 20% tilt away from information technology if you go for a UK index. Where does that allocation go? Well, it's primarily in consumer staples. So these would be companies like Unilever, Diageo, and British American Tobacco. There's also a big tilt towards energy companies, but also miners. So that would be mining stocks like Rio Tinto. Now remember that this was one of the complaints which Nick Train had, which is that the UK has almost no tech in it. Now you might think that's a good thing because the US is too concentrated in tech, but certainly compared to a global index and in terms of success recently, tech is where it's at. Whether it's cutting edge tech apps like OpenAI and ChatGPT, all the way down to just reading your email, the UK is just massively underrepresented in tech on the global stage. But it's not all negative. There have been some huge UK success stories. So if we look at the returns sector by sector for the UK going back a decade, you can see that some of these sectors have outperformed the United States. And in particular, I'm talking about the industrial metals and mining sector. That's given an annualized return of just under 20%. Another sector where we're very strong is pharmaceuticals, biotechnology, and cannabis producers. The UK produces cutting-edge research in its universities, and that's fed through very successfully into innovations in the biotech sector. Other notable sectors would be construction and materials, electronic and electrical equipment, but also media. So perhaps one way to address the problems that we've got is to focus on what's worked in the past, rather than trying to breathe new life into sectors which are lagging further down this list. Another thing to remember is that when tech falls, the UK outperforms because it's got no tech. It does have a lot of energy and mining companies which did very well in 2022. So if we break down the annual returns of the UK relative to the US, which you can see beside me here year by year, notice how in 2022 there was a blowout year for the UK. It outperformed the US by a massive 18%. Of course, that's quite unusual. It also happened in 2016, but having that huge concentration in tech will sometimes be a hindrance. It's also good to see that the UK government has actually seen that there is a problem and admitted it, and they've tried to create something called the Edinburgh Reforms. Here's Jeremy Hunt announcing that on HMT's YouTube channel. However, I'm not convinced that a lot of these measures are going to make a big difference. So for example, they've got overhauling the UK's regulation of prospectuses. So when a company lists on the exchange, the rules will be different. They're changing the ring fencing regime for banks. The problem in 2008 was that investment banks were blowing up retail banks, so the two were separated. I'm not convinced that that's a good idea to bring them back together. They're going to reform short selling so that we can have more short selling in the UK where you sell a stock you don't own, and you do that by borrowing it, and hopefully you profit from a falling share price, just as you would profit from a rising share price if you're long the stock. Another thing is that they're reforming the senior managers and certification regime, where a senior manager at a bank would be on the hook personally if someone in their department did something dodgy. Again, I'm not sure that's a step forwards. I think it was actually a pretty good idea. In conclusion then, I think the fundamental problem for the UK is an economic one, and that's about productivity. The amount of goods and services produced per unit time per employee is not growing very quickly in the UK relative to other developed countries. Now that's going to have an effect on the bottom line, it's going to have an effect on stock price growth, but also on the broader economy. I think underinvestment is part of that problem. So anything the government can do to help address that will probably help towards also stimulating the stock market and the broader economy. Another problem reported by many UK startups is that the initial capital is available to start up a company, but once you get to the next stage of development, when you want to scale globally, that is much more difficult. Some people describe this as mezzanine capital, where you've actually gone past the startup stage and you're just trying to scale up into a really large company. Perhaps one way the government can ensure that happens is to mitigate the risk for these venture capital companies at that stage of development by taking some of the risk itself. But I think that's certainly been holding back the UK. And as Paul Marshall pointed out, I think the focus on dividends is a toxic thing. That doesn't encourage companies which are focused on growth, and that's certainly held back innovation in the UK. So I wouldn't get too hung up about the size of the UK relative to the global markets. I think as long as you understand the nature of the UK market, which is currently it's very cheap, but also does pay a high dividend, and it has that kind of tilt towards value as a result, and it has that unusual sector composition, then you can still work out its role within a portfolio. Now, don't forget our offer from NordVPN. You'll find that in the description beneath me. And as always, thank you for listening.